Hi friends, welcome to our channel. In today's world, one of the most important financial decisions people face is whether to buy a house or continue living on rent. This decision is often influenced by emotions, society pressure, and personal expectations, but the real answer becomes much clearer when we look at the numbers. To understand this properly, we need to think in terms of rental yield, investment growth, inflation, and long-term financial planning. Rental yield is a simple concept that compares annual rent with the total value of a house. For example, if the monthly rent is 15,000, the yearly rent becomes 1,80,000. If the property value is 50 lakh, then the rental yield becomes around 3.6%. This percentage helps us understand whether renting is financially expensive or reasonable compared to owning a house. Now imagine a house worth 1 crore in a major city. Based on average rental yield, the monthly rent may fall around 24,000 to 25,000. This amount can vary depending on location, demand, and city conditions. Along with rent, tenants also need to pay advance money, which can range from 2 months to even 12 months depending on the city. This upfront amount also becomes part of the financial calculation when comparing rent and buy decisions. When a person chooses renting instead of buying, there are some important financial advantages. First, there is no need to pay a large down payment, which is usually 20 to 25% of the property value. Second, the difference between EMI and rent can be invested in financial instruments like mutual funds or SIPs. Third, while rent increases every year, disciplined investments have the potential to grow at a higher rate over the long term. This creates an opportunity cost benefit where money works in two directions instead of being locked in one asset. Let us consider a long time horizon of 20 years. During this period, rent usually increases every year, and when adjusted for inflation, the total cost may appear lower in real terms than expected. But the important factor is what happens to the money saved during this time. If the down payment and monthly savings are invested properly, compounding can significantly increase wealth over time. This is where long-term investing can sometimes create stronger financial outcomes compared to owning a house early in life. Now let's understand the buying side. When a person buys a house worth 1 crore, they usually pay around 25 lakh as down payment and take a loan for the remaining amount. Over the loan period, they pay EMI every month, and a large portion of this goes towards interest. Along with this, there are additional costs like registration fees, maintenance charges, and property-related expenses. Over 20 years, the total cost of owning a house becomes much higher than just the purchase price. Even though the property value may increase, the overall gain gets reduced by interest payments and maintenance costs. When both options are compared over 20 years, renting can sometimes create a financial advantage if the saved money is invested wisely. The combination of down payment investment and monthly savings investment can grow significantly through compounding. This is why in certain cases, renting and investing can build more wealth than early home ownership, especially when financial discipline is strong. However, the decision changes when we look at a longer horizon like 30 or 40 years. Over a very long period, real estate generally increases in value, and owning a house can become more beneficial. The advantage of ownership increases with time because the asset appreciates while loan pressure eventually reduces. But this only works well if the person actually stays in the same city and same property for a long duration. Lifestyle flexibility is also a very important factor. A home loan creates a long-term financial commitment, which can limit job changes, relocation, and lifestyle choices. Renting gives more freedom to move cities, explore opportunities, and avoid being tied to one place. In early career stages, this flexibility can be more valuable than ownership. A smarter financial approach is to focus on building investments first and then deciding on property purchase later in life. In the early years, renting and investing the difference can help build strong financial stability. Later, when income is stable and life goals are clear, Buying a house becomes a more practical and comfortable decision rather than a financial burden. If you like this video, PLS, do like, share, subscribe.